now we are going to discuss the tax-based definition of income received in advance. In terms of paragraph 8 in IAS 12, it's defined as follows. In the case of revenue which is received in advance, the tax base of the resulting liability is the carrying amount less any amount of the revenue that will not be taxable in future periods. So I just want you to understand or think about two steps before you get to the definition. First, I want you to identify how the income received in advance will be realized to profit and loss. So at what point, let's say we receive the income first, or the cash, debit bank, credit, income received in advance, financial position. Let's say we're dealing with 2,000. Okay. Now, as the services are provided or the goods delivered, you are going to do the following. You will debit income received in advance, the obligation will get smaller, and you will credit revenue as the actual revenue is earned. Okay, and all the revenue recognition per IAS 18, those criteria are met. So that might happen over a period as services are provided, goods delivered, etc. So that could be 2 journals, for instance. Okay, so I want you just to identify what triggers that release from the balance sheet, the income received in advance, to the statements of profit and loss and OCI, the credit revenue. Okay, so that's step number 1. Then your thought process, the second step is, ask yourself, is this income going to be taxable when realized? So looking at my journals, where does the tax man get involved here? Let me tell you. He is not going to tax you twice, first of all, but most tax authorities will work on earlier of accrual or cash receipt. Here, we definitely received the cash before the items became accrued. Okay, so when the cash is received, that's when it will be taxable. Okay, the 2 revenue amounts will not be taxable again. Okay, so understand that. Now we can have a look at the definition. It's quite a simple one. Tax base, carrying amount, minus the amount not taxable in the future. Before we look at an example, let's quickly just go through some rules. I know accounting students love rules. If the carrying amount of income received in advance is bigger than the tax base of income received in advance, you will have a deferred tax asset, okay, which arose because you had a deductible temporary difference. For the situation where the carrying amount of income received in advance is less than the tax base thereof, you will have a deferred tax liability, which resulted from a taxable temporary difference. Let's have a look at a basic example here. So, deferred tax, you calculate. You have your following headings: your carrying amount, your tax base, your temporary difference, and deferred tax balance. Let's work on 28% here as the tax rate. So the first thing, let's say we have income received in advance at the end of the year of 1,000. So we originally received 2,000. We've settled or provided services to the value of 1,000. Therefore, at reporting date, we still have 1,000 income received in advance left in financial position. The tax base of this income received in advance will be the carrying amount of 1,000 minus the, just write this down again, carrying amount minus the amount not taxable in the future. Okay, how much of that 1,000 will be taxable in the future? Well, it's already been taxed in full when you originally received the cash, the 2,000 Rand cash up front. So the amount that will not be taxable in the future is 1,000. The tax authority will not tax you again. So what's my tax base here? 1,000 minus 1,000 is 0. So tax base is 0. Temporary difference is the carrying amount minus the tax base equals 1,000. Okay, that 1,000 times by 28% being the tax rate will give me my deferred tax balance. Okay, that deferred tax balance here, 1,000 times 28 is 280. Will that be an asset or liability? Well, the rule here was if the carrying amount is bigger than the tax base of income received in advance, you will have a deferred tax asset. And that arose because the 1,000 temporary difference is a deductible temporary difference. Great, I hope this has helped. Please make sure you know and understand these tax-based definitions. You will use them for every single deferred tax working you do, both in your academics, in your professional life. It is incredibly important. Thank you.